mess with. The fundamental flaw in the generational gap in North America is the lack of respect and loyalty. This is one thing that separates the Japanese market to the North American market, and it's one of the most fundamental key points to recognize when entering this market. My name's Robbie, and my colleagues and friends here are Anders and Tyler. And we're here to tell you that the only way to enter the Japanese market is to establish your business model organically in order to really capitalize on how their culture actually works and how to utilize in order to gain a foothold. And the reason for this being is because the regulatory body has so much control over that Type 1 license, and they are an absolute connection that you need to have, and by doing it in the wrong fashion, you will not be able to secure that license and you will not be able to expand into Japan. Now I'm going to bring up, and now the primary issue here today is to really figure out how Orbis is going to move into the retail investment. Secondly, it's how you're going to actually going to do it, and whether or not, what is it going to cost for your firm to acquire a firm, or what is it going to cost for your firm to actually grow organically. And Tyler will get into that later in his quantitative analysis. And lastly, it's how to build that momentum in Japan once you've entered as a foreign player. And we will get into that for you in detail in our implementation plan. Now Anders is going to go ahead and talk about the internal analysis and an external analysis, just to give you a real fundamental basis of what you're facing.
Thanks, Robert. So like you said, I'm going to break down the internal and external analysis of Orbis and moving into Japan, and then finally dive into the alternatives we looked at and why we selected the recommendation that we did go with. So first thing we noticed was that the market that you'd be focusing on in Japan is the 25 to 50 years of age, and this makes up 38.1% of the Japanese market, which is absolutely huge. This is a huge target market for your company moving forward. Secondly, that there's 250 JSDA Type 1 members that you would be entering into that market, so this makes up nearly 50% of investors in Japan. So you would be stepping into a bit of a saturated market, but we believe with our recommendation there shouldn't be an issue to find yourself there. And the new NISA capital gains exemption, that account that's been established in Japan, this just means that Japan is shifting towards a long-term investing, which is exactly the type of fund that you are. So this plays right into your hand, and this means that you would be extremely successful moving into Japan. And finally, Japanese culture, like Robbie touched on, is extremely different compared to the Western cultures. And respect is something that is absolutely essential if you want to be successful in that Japanese market. Japan has a large potential for your company and is the appropriate move for Orbis moving forward. Now on to an internal analysis of Orbis. So you guys obviously are a long-term fundamental international investment fund. You are willing to take those short-term losses for long-term gains, and you've proven this time and time again. You also have access to two main funds that your Orbis Access contains two main funds that you started in the UK and you want to branch out into Japan. And these are the Global Equity Fund and that Global Balanced Fund. So this just simply means you have a diverse investment vehicles that you're willing to attack Japan with and really be successful. And you have a strong global reach. You operate in 9 different countries and you've entered foreign markets before. We don't see the need for you to acquire a company to assist you in entering those foreign markets when you've done it time and time again and proven yourself to be extremely successful at doing so. Finally, we're now on to the decision criteria, and these were the 3 critical success factors that we knew we must hit in our recommendation in order for your company to prosper moving forward. So first being growth. We need to ensure that Orbis is positioned well for that long-term growth. You guys are a long-term fund, so we're looking for long-term growth here, not short-term gains. Sustainability. We need to ensure that Orbis is set up for not only to be sustainable in the short and medium term, but in that long term. And shareholder approval. We have to ensure that all the stakeholders in Orbis are in approval of our recommendation. So the first alternative we looked at was the purchase target, which you had mentioned to us. yes, you would receive immediate funds established already in Japan. This is an advantage, but the disadvantages here heavily outweigh the advantages. There's a large amount of different operations with this company that you are completely unfamiliar with. And to become familiar with, you would either have to hire new staff or try to use the staff that you already have, and you would not be nearly as efficient as growing organically in Japan. Option could be that you could slash and burn, basically, or strip that company for parts and get it to something very similar to Orbis. But once again, with Japan being a country that is heavily reliant on respect, this is something that would completely deteriorate the respect of not only the Japanese employees, but the Japanese investors, and could result in a failure completely. And this is a greater input cost, as Tyler will walk you through in the quantitative analysis. The second alternative we looked at was looking at acquiring a firm that is extremely or very alike with your firm, just in line. So it is in line with that business model. You wouldn't have to spend much time trying to align those business models, as you've stated that is extremely important for your company moving forward. But this becomes much more difficult to locate a seller. There are not going to be very many firms that will be extremely comparable to yours, that you won't have to shift business models. And there will be a greater control premium, because with the less likelihood of finding a company, that also means there's a less likelihood of them willing to sell to you. So you're going to have to pay a higher premium there. And this may take more time, like I said. And now on to our recommendation, which we're very excited to bring you today. It's to grow organically. So start a greenfield operation in Japan. This is more cost efficient at just over $1 million of initial cost for you. And you're going to leverage that core technology using the K with that Orbis access in Japan and use that for long-term growth. This is in line with your business model, obviously, as you would just be growing organically. And you've started numerous firms around the world, like I mentioned earlier. You've done it before, so you can do it again. We are extremely confident that this will be successful. The only disadvantage is that it may be difficult to gain a bit of traction, but with the international reach that you already have, we don't see this as a significant risk. I'd now like to introduce Tyler to walk you through a bit of the financial analysis.
Thanks, Anders. This is the cornerstone of our presentation. We have spent 3 hours poring over the numbers to get you the best possible valuation so that you can make the best decision now and in the future. We know that qualitatively, Target didn't really make sense, but maybe quantitatively, if it was a good deal and to get you a good position, then maybe you could go for it. So we use 2 valuation techniques to arrive at a value for Target. We use a DCF and a relative valuation based off the industry average. For the DCF, you can find a better cash flow breakdown in the Appendix 1. Some assumptions I wanted to lay out for you is that we did use a 15% revenue growth rate, and that was a 5-year average. It's been pretty consistent for the past 5 years, so we feel going forward for the next 5 years it should be pretty consistent. We also use a discount rate of 20%. Now, when you're going into a new market like this, it's kind of testing the waters. You don't really know what to expect. So we want, as a high discount rate, being a little bit on the safe side, being a bit pessimistic, but you're going to want that return for your equity. You're going to want that return if you're going into this market buying this company. We also use a terminal growth rate of 3%, which is a little bit low also, but it's just a little more safe side. And this got us an applied equity value of $1.4 million, which is 14 million in US dollars. And onto the relative valuation, we used the industry average, so the closest comparable sets to what Target is doing right now. We used 3 different metrics. We used the price to equity, we used the forward price to equity, also used the price to cash flow. Now, throwing these in, using the averages and using the current earnings and cash flows, this also got us to a valuation around that 14-15 billion or $1 million, and this got us a final target price of about $14.5 million, and that's in US dollars. So in Canadian, that's about 21 million using the exchange rate, and that's not including the control premium that you're going to have to offer these guys, which is about 15 to 30% as an industry average. So that's going to bump this up to a range where if you're just going to be looking to sell off some of these parts, it may not be worth it right now. So quantitatively, this Target didn't really make sense either. So what we want to do next is see what's going to happen if you go with that organic operation. We want to build you a model to see your forecast, your revenue, see your net present value of this investment. So some of the assumptions that we need to line out is that right now the market is about $80 trillion in yen, that's about 800 billion in US. Even if you capture 1.1% of that market, that's going to be quite a bit. So we want to say that pessimistic side, we want to use that 0.1%. We're also going to assume this is going to grow about 10% a year. And we also assume that percentage of fund that they're going to go about 70% into that global equity fund, so a little bit higher return, and only about 30% into that balance fund. And we also assume that we looked at your geometric average over the past 5 years, and we use this to assume how much you're going to beat the benchmark by. Geometric average is a better predictor of multi-year. So it's about 2% for the equity fund, it's about negative 2% for the balance fund. So you're going to get a little bit, you're going to have to pay out a little bit of fees on that one, but we assume this is going to get a little bit better, but we stick with that negative 2%, and we had that 2%. So we projected your cash flows using these assumptions. Sorry, if you switch the slide. And we also use the profit on operating margin about 30%. That's just industry standard right now in industry like yours, and a 23% tax rate, which is also just the same as targets. We just going to Japan is going to be the same tax rate. And this gave a net present value of the next 5 years of $1 million US. And what that's assuming a initial investment of about $1,050,000 US dollars, is about 1.5 million Canadian dollars. It's on the high side again, just making sure to stay safe. But after 5 years, you're going to have a very positive net present value, and that's about a 96% return on your investment in 5 years, which is an amazing return on investment. And if you look again at your appendix, you'll see that the net present value, if you were to go with target, would be about negative 8 million. 8 million in the next 5 years. So growing organically was a much better choice. It's more prosperous in the future. It's quicker to return your investment, and it's also going to be the safer and best way to grow into Japan. I'm now going to pass it on to Robbie to walk you through just exactly how you're going to do that.
Thank you very much, Tyler. Now, slow and steady. This is going to be the best way for you guys to enter Japan. Your company is not in a place where it's an urgent entrance into Japan, so we don't want to take an acquisition and put lipstick on a pig. What we're going to do here is we're going to give you the fundamental basis to establish yourselves in that market and do it correctly. So that's why slow and steady is our goal. We're going to do long-term growth for long-term gains and not a short-term gain model, which is exactly what Orbis is about. Now our first phase, slow. You need to start immediately and start seeking Japanese employees. In order to really establish yourselves in Japan, you need to follow the regulatory body, and in order to do this, you need 1 to 2 members on your team in Japan that have a minimum of 3 years experience, and they're also going to need to know the culture and speak the language. So we say that the best way to do this is to find 2 well-established Japanese investors that are going to really give a tangible benefit to your corporation and really see that benefit, and then you're going to mix that with 1 other additional Orbis employee that will really help them make that transition into the Orbis culture, which is a major impact in whether or not they're going to truly fit with your firm. So we're going to say do this immediately. It's going to cost roughly $10,000 to really find that employee, and that's going to be in a 0 to 4 month timeline, just so it gives you enough time to make sure they're going to fit the culture and make sure that they're going to be able to really uphold to the standard and the quality that the SRO is going to need in order for you to acquire that Type 1 license. Second, you're going to start the application for the JSDA Type 1 license. Now this is a 1-year process. It's timely. It's going to take a bunch of different hoops to jump through, but if you do it correctly, you're going to have the proper connections with that regulatory body that will allow you to really establish that fundamental business model within Japan to allow you to succeed in the long-term future. So we're going to say you're going to do this starting right at the end of the 4 months. Once you have secured that letter of offer to the 2 employees that you see fit that are going to really be the beneficial employees to your business, you're going to start that process. And that's going to be starting at the end of 4 months. It's going to take 1 and then roughly ending in about 1.5 years. Now this is going to begin a horizontal, and then also begin that horizontal integration. You've proven that you have the technology already, and you've established that online trading platform in the UK. We want to go ahead and take the same platform and just start to integrate it into a different model that allows you to really utilize it and still maintain those securities and bring it into the Japanese market. This is going to allow you to leverage your current technologies and actually make it so it's beneficial so you can seek some sort of synergies of your current operations. And we're going to say you start this immediately and do it 0 to 5 months so you can start to test it around the 5-month mark so that when it comes time to rolling it out, it's fully ready and it's full and ready to go. And so we're going to say that roughly it's going to be about a $30,000 cost, but it could differ depending on the complexities and the scale of that actual business. Now, second off, this is going to be the medium term. We're going to go 1.5 to 3 years. And you're 1.5 to 3 years, and you're going to finalize the license with the GSDA Type 1. This means that your senior management from all over the world, your senior management from your 2 gentlemen that you've hired in Japan, your management, your manager, your investor that you're sending to Japan to really establish, you're going to have to travel back and forth to meet with the regulatory board. They like to meet with managers over legal counsel, and this has to do with a cultural and a respect thing, and this is why you're going to have to really jump through the hoops and lean to their culture and lean to what they really like in order to really secure your business there. So this is why it's going to really allow you to maintain it, but this is once you secure it, it's going to allow you to actually start your business and start to really push that forward growth into a point where you're actually going to be able to start to realize your gains. Now you're going to launch that retail platform. Like I said, you've already established yourself in the UK as having that retail online platform, and that's what you guys want. You don't want to come in and acquire a firm that has a bunch of different investment banking propositions. You have a bunch of different aspects to a large acquisition. You don't want to do that. A slash and burn or a strip it for parts is seen as a very predatory way of entering a market, and that is going to be detrimental to your connection with that regulatory body, and it's going to be detrimental to that Japanese market. You're not going to be able to maintain those key employees that are going to be what is going to allow you to keep that JSDA Type 1 license. Even if you came in and you did a slash and burn, if you don't keep those key employees, they can still take that license away from you. It doesn't mean you bought yourself a license, it just means you bought yourself a possibility at a license. And that's why the long-term growth model is actually going to be more beneficial overall. So that's why when you launch your own trading platform, you've already established it, it's going to really seek that reward because you've established those connections already. That regulatory body likes you, you have 2 employees that are now fitting in within the Orbis culture, and you're going to be able to bring that forward. And that's why you're going to start at this point in time marketing the new regulations around the NISA to those new users. There's a shift in the Japanese market. It's shifting to long-term investments, which suits what your firm is all about. Orbis is a long-term investment fund. The NISA regulations is above 5 years is when you're going to be able to allow to see those capital gain exemptions. So that is why you need to stress that, and that's why another major player is going to be your balanced capital global fund. This is more for long-term investors, a little bit more risk averse. If you look at the target generation, it's 25 years to 55 years. When you start to shift that more, you're going to start to see a little bit of a more risk adverse inherent behavior between these individuals, and that's why this is going to be the target market that you're going to want. But that is why you're going to see that benefit and increased market share. And lastly, the 3+ years. This is where you're going to start to realize your gains. You've really established your foothold in Japan, and now you're going to see that return on investment of 96% by year 5. You're going to capitalize on the shifting trends in the market, and that's why you're going to really focus on growing the global fund and growing the global balance fund, because you're going to see that risk, that flight away from risk, and you're going to seek that benefit of the long-term gains from your fund. Now, with every great implementation plan, there are risks. But with our risks, we found great mitigations that are going to allow your firm to really grow and really make sure that everything comes through. Now, the first risk is brand awareness does not transpire. That is a major risk. You're a new player to this. It's going to be a tough market to really gain foothold. And the impact of this is that you're going to have a lower sales in the first years, and it's going to prolong that return on investment. But we think that because the market is shifting towards that, you're going to see it just fine. Secondly, corporate governance might restrict your talent pool. The reason why this is because the way you operate right now might not fit in with the proper Japanese employees, but we think that you're going to be able to seek it just because you're taking that extra time. There's one more there, but we'll touch on it a bit later. If you do have any questions, you can come back to it. Now, what have we done for you today? We've shown to you that Orbis is going to seek the best return on your investment by going organically. You're going to respect those connections that are quintessential for making that pure and long-term growth your company wants within the Japanese market. We've told you that the acquisition A is not only quantitatively irresponsible, it's qualitatively irresponsible. And that's why the true benefit that you're going to seek is going to be through organic growth and nothing less. That being said, we will now open the floor to any questions.
So you led off by saying that one of the biggest risks is getting a license, having a good relationship with the regulator.
Yeah.
I'm a bit confused. Wouldn't it be less risky to buy an existing company that's got a license in place and has an existing relationship with the regulator, as opposed to hiring a bunch of people, having to build that from scratch with the risk that might be wrong?
Yep. So one of the things that we established is that when you do buy that company, you're going to have to really strip it down. Your fundamental business model is you like to have 2 to 3 employees. By buying a company and firing employees, if it's a bigger firm, or especially with Target, you're going to have to strip it for parts, sell away a lot of their assets, could be jobs lost. We think that's a major risk, and because you're buying that company, you're essentially trying to buy that license. If you cannot secure key employees, you're not going to be able to secure that license, because that license is 100% determined on the regulatory board giving you the license, not just because you bought a firm. That doesn't secure your license.
So what about going for something like option 2 then, purchase Orbis Comparable, or another firm that is better aligned with Orbis that has a license?
Yeah, absolutely, and that's another option, but we find that your integration between your current model and your current model that you're using in the UK isn't going to be a synergistic flow, and it's going to cost more money to actually try and integrate these 2 firms than it is going to just to establish this relationship and go through the process to really organically do it.
Just for my clarity, you mentioned marketing budget kicking in every 1.5 years and 3 years. You mentioned marketing budget 5 to 10% of Japanese sales. Do you mean the amount that's been invested, or is it your revenue, or is it the margin that's 5 to 10%?
Sorry, that was unclear. It was the 5 to 10% of the current investment, just for the 1.5 to 5 year mark, just to really establish that it's the amount invested.
So based on which criteria? Revenue, or margin, or the invested amount? 5 to 10% of what?
Yeah,
Sales. What is sales?
Yeah, based on the revenue fee. So that would be considered your sales, the revenue fees.
Good. Good 2-part question relating to your NPV analysis. I'll ask them both at once. Could you justify, please, your 10% growth rate that you've assumed in the first 5 years? And the second thing is, if your JSDA Type 1 license doesn't come for 2 years, when would revenue start? And would that account for?
So we justify the 10% growth rate because we started with such a low market capture at 0.1%. We think that going for 10% after that, and really once you have that foothold in the market, you'll get more and more investors wanting to go into your fund, since you're such a proven company. And also, if it does happen, the license does get pushed back, it's going to change the discount a little bit. It's going to be discounted at, it's going to be, the revenue we discounted further down, so that it'll just be a little bit less net present value. But we just wanted to show you what it's going to be like once you get in there, and it's going to be still good.
Sorry, just a timeline question. The approach being slow and steady, right? Could you comment on the risk of missing an opportunity there?
We feel like that missing an opportunity, you may have, the thing about the Japanese market is you may only have one shot at this, one trip to the trough. So we want to make sure that you do take your time and don't rush into buying or acquiring a company that, like we mentioned before, you might have to strip down for parts, or it might not have the right fit. So by growing organically, yes, it might take a little longer, but we want to make sure that one trip is the best trip, and that you will, in fact, ensure growth in Japan.
Isn't the NISA a big catalyst to get people investing? And if I wait and take a slow and steady, might I miss that opportunity?
You would have the ability to allow users to start investing in 1.5 years. The current market outlook, as of the end of 2015 going into 2016, might even signal that it might not even be the best time for investors to start investing into Japan. So by really prolonging this into a 1.5 year span, it's actually going to maybe allow the market to recover and really seek the the full tangible benefit and fundamental benefit of the market having a recovery in 2017, and that'll be when your platform will launch. So in the end, it's actually the slow and steady mark is both for the markets better and also better for investors as a whole.
Okay, you're done that question.
Wow.